Bismillah, alhamdulillah, wa salatu wa salam ala rasulillah, amma ba'd. Assalamu alaikum wa rahmatullahi wa barakatuh. The idea behind today, so the series that we've been looking at, the first bit of the series was why should we even care about Islamic finance? Why should we care about anything to do with money? And in a nutshell, what we were saying was that firstly, Muslims globally are 20% poorer than the rest of the world. Muslims in the UK in particular, 46% of Muslims live in the 10% poorest areas in the UK. And out of the top 100 companies in the world, there are 0 companies that are Muslim. And the first company that appears on that list is 122. And given that Muslims are 25% of the world's population, you'd expect there to be a lot more. But unfortunately, we're as a community, we're lagging behind. And so the whole purpose of this entire series and raising awareness of personal finance is because if we as Muslims can sort out our personal finances, then inshallah we are doing a genuinely good thing towards contributing to the betterment of our ummah as a whole. So that was last week. This week we're going to go into the real nuts and bolts. Like, this is really practical stuff today that's going to actually directly inshallah be helpful for you guys on your investment side of things in particular, but also generally personal finances and how to think about money in general. And then finally for the week 3, we'll talk about Islamic mortgages and all the juicy debates. I've left them right to the end. You had your hand up?
Okay, I wasn't here last week, but I just wanted to ask, is this more of a Q&A at the end, or is it more of an interactive session?
It's mainly Q&A at the end, but if there's something that is really, really burning, then feel free to let me know. So in terms of what we're going to do today, the first thing is that we're going to go through a 4 kind of tiered approach to personal finances. So when you think about your personal finances, I think this is going back to your question, your point the brother made about how do I kind of think about my personal finance in general, and how do I take it as a step-by-step process. So we'll go through that step-by-step process. The second thing we'll do is go through the essentials, absolute essentials of investing. Like how does one think about investing, right, in the first place? Because ultimately we know investing is about, putting some money in and making some money out at the end of it, ideally more than you put in. But really, what are the kind of things that the professionals and the experts and the 1% use when they think about their investment? And then finally, we'll go through specifically a few key investment categories. So 5 in particular that everyone should be aware of. We'll go through them. So stocks, sukuk, property, savings accounts, and then private companies as well. And within there's a lot of different flavors. It's like, these are 5 different chocolate companies, and within each of these chocolate companies, we've got a whole bunch of different flavors and brands. So we'll go into that as well, inshallah. But before I dive in, I just wanted to talk about who we are and where we come from and all that sort of thing, so that you kind of understand where we're coming from. So Islamic Finance Guru, we've been running it, alhamdulillah, for the last 4.5 years. We started off as a community blog because essentially I went online and I was doing my master's at the time, my master's in Islamic banking, and I was doing my alim course at the time as well. And I went online to just find stuff as part of my research for Islamic finance, and I couldn't really find anything that was either not really, really simple, so like this is halal and that's it, or this is like a really academic, detailed discussion of, takaful. I wanted something in the middle that made sense and explained things, but wasn't, really, really dense. And so I started writing for myself, and alhamdulillah, people found it quite useful. We started reviewing various different companies and, the shari'i side of things, the legal side of things, and that kept on growing. And alhamdulillah now, so I, as a profession, I was a corporate lawyer, and things, with Islamic Finance Guru just really, really snowballed to the point where I've now gone full time on Islamic Finance Guru and just focused essentially, my career and my life on this, because I think it's that important as an issue for the Muslim community. And the idea behind it was pretty much what we discussed last week, which is we want to help Muslims essentially get better off economically, because we think that that is one of the key things that we can do to make ourselves better off as an ummah generally as well. So that's where we're coming from. We're not owned by any bank or any financial institution. We don't have any influence from that side of things. So anything we say is basically what we want to say, and we do say that. So if you go online and you find our reviews, lots of companies are they'll have issues with what we've said, but we try and just be honest, because we think that that's the most helpful way that we can help you guys, but also help the companies ultimately as well. Because if they don't have anyone telling them that this is what you should be doing right, and this is what you should be doing that's wrong, they're not going to change. So how do Muslims get richer? We said last week that there's two key things. One is sort out the personal finances, and the other one is to get Muslims into entrepreneurship to make the next big businesses. This week is all about the first of that, to sort out personal finances, which is absolutely crucial, and Muslims and actually a lot of the wider community are not very good at that. So let's dive in. 4 tiers of personal finance. Firstly, what is personal finance? Any ideas? Any thoughts? Personal finance, yeah?
Is that how to manage your day-to-day expenses?
Yeah, I think that's definitely part of it. Any other ideas? Yeah?
Well, how to manage your own money and stuff like that, how you spend it.
Brilliant, absolutely.
Money as well.
Absolutely, brilliant. Yeah, exactly. So, personal finance is just a term that we use to talk about our relationship with money. How we interact with it on a day-to-day basis, as the brother said, how we invest in it for the long run, what we do vis-a-vis our employment and where our salaries are coming from, how does that whole thing work, and also what we do with regards to our debt, credit cards, houses, mortgages, student loans, all of these things that we have, insurance, touch points that we have with the financial industry, and how we interact with that in general. And the key thing is that if you manage your personal finances well, it can make you a lot of money. And if you manage your personal finances badly, then of course that's not going to make you end up in a great place. But if done well, it can be really interesting, I think. I'm quite sad like that. But also it can be really, inshallah, profitable for you guys. I appreciate that the screen is not the best that it could be, but inshallah, what I can do is I can make available the slides afterwards so that everyone has them, and then you can refer to that as well. And this will all be, by the way, this is getting recorded, so you'll have this to refer to whenever you need to, inshallah. And also I live in Goodmays, so you can just get hold of me as well. So in terms of the 4 tiers of personal finance, the first thing, absolutely essential, is if you've got debts, then you should be clearing those debts. And this is the kind of debts that I'm talking about are not necessarily, just your mortgage. So a mortgage is a different kind of debt because it's a long-term debt that I'm not really discussing here. I'm talking more about, a debt to a family member, or a debt to a credit card company, or a debt to, you're in overdraft, or you've got payday loan out. And obviously, as Muslims know, a lot of this stuff is not permissible, but unfortunately, we sometimes, end up in situations where we have those kind of debts. We should be clearing those debts first and foremost. And the reason for that, the essential reason for that, is because if we don't, they compound. And we'll talk a lot about compounding. What happens with compounding is, let's say you have a £100 debt and you are owing 10% in interest, so you have £10 that is owed. If you don't pay that £10, then that adds on. And the next year, the 10% is charged on £110, and that becomes £11 because 10% of 110 is 11. So that's added on as well. And if you keep on mounting that, suddenly it becomes massive and it becomes out of control. And this is how credit card companies and banks and many others make a lot of money out of us. So we should be really, really on top of that. That's absolutely essential. The second thing we should do is, once we've cleared our debts, we're back to zero, we should then start thinking about building a buffer. So a 3 to 6 month buffer, a savings buffer, in case something goes wrong, because you can never control what happens in life, right? We weren't expecting this virus to come up. And businesses are now, if you work in the tourism sector, people are laying employees off. There's a whole host of various things being cancelled, all sorts of disruption, completely unexpected, and people are going to suffer as a result of that. Now, if you had a 3 to 6 month buffer, that puts you in a much better place to deal with these sort of things. And the kind of places that you put this 3 to 6 month buffer is stuff that is liquid and stuff that is safe. What do I mean by liquid? Any ideas? What does liquid mean?
Available cash.
Exactly. So liquid would be something like money in your bank account, or money in a savings account that you can quickly get, or money potentially in a stock market that you can quickly liquidate. Something that would not be liquid would be property, because if anyone has had any property dealings, it can be a mission to try and sell a property. A property is not liquid, right? So you want it to be in liquid stuff. The third thing is that you should be looking to stop renting. So now let's say you're 25, you've got rid of your debts that you had, you've got yourself a 3 to 6 month buffer that you've built up, maybe like £5,000, maybe £7,000, something like that, a nice little buffer. And then you're now looking, what's the next thing that I can do? The next thing that you can do is to stop renting. So we've actually done we've done a calculator on the website called Should I Buy or Should I Rent? And so on the background to this is that you go on here and you put through all the different steps. You put in your house value, your deposit, the mortgage term, the mortgage rate, the monthly rent. Actually, let's just do it. 400,000. I wonder if it'll work, because I'm not sure I have internet. So it's telling me if you choose to buy after 25 years, you would have a net profit loss of 60,000. And then on the other side, monthly rent of 1,800. And let's say you're going to make like a 7% return. If you choose to rent after 25 years, you would have a net profit loss of 141,000. So in this situation, you should probably rent, as you will otherwise end up losing out. But then I think the key thing is I've put the deposit really high. Like most people won't have 200,000. So let's put that. And there you see it goes down a lot. And so now it's saying that you should buy, because otherwise you will end up losing out 500,000 over 25 years. So, have a play with that in your own time. But basically, for majority of people, they should probably stop renting, because that's just money down the drain. So what does that actually mean practically? What that means practically is that you will need to then save up for a deposit, right, with an Islamic mortgage, or you need to save up for a deposit for a shared ownership scheme, for example. And we'll talk all about this, inshallah, next week. So that's what you would be doing there. And you would be looking, depending on how much you're looking to save up, you would be looking to keep it fairly liquid, because you don't want to lose, you don't want to be able to, lock something away for 5 years or not buy a house for 5 years. But at the same time, you want to be putting it in something that's going to be making a little bit of money. It depends on how much that deposit is and how much of a return your investment is making as well. But typically people will be saving anywhere between 2 to 5 years. So try and keep it liquid, but look for something that's going to make a little bit of return, but not something that's so high risk that you could actually end up losing it all, because ultimately you want to end up with a house, and you won't do that if you don't have a deposit. We will talk about risk and where you can put it later on, inshallah, as well. And then the final thing, this is where you kind of, you've done it, you've made it, you've got yourself a house, you've got yourself a buffer, you've got yourself no debt. Now you're thinking, okay, I've got some spare cash coming in. What do I do with it now? Now the key thing here is that you should be thinking about what are your objectives when it comes to investment, because that then determines, crucially, what kind of risk profile you have. Because people, when they think about investment and they don't think why they're doing it, they end up just putting it into anything. But if you think, actually, hang on, now I'm investing, I've got my house sorted, I'm basically now investing for 15 years' time for 15 years time when my daughter Ruqayya is going to go to university. That's actually what I'm now saving for. Now that you know that you've got a 15-year time horizon, that suddenly means that you can be a little bit more aggressive with your risk, for example, because over 10 to 15 years, things generally go well in the stock market, for example, or over 10 to 15 years, you can now put this money away, some of it, into a property, because even though property is illiquid, it's hard to get cash out of it quickly. Over 10 to 15 years, you're probably going to be all right in being able to sell it at the right time, etc. So that's really important to think about why you're saving. That's really important. The other thing is you should be trying to look to diversify your portfolio. Your grandmother was right when she said, don't put all your eggs in one basket. It's so true. Don't put all your eggs in one basket, because when someone says to you that this is an investment, it's really low risk, nothing can go wrong, just put everything into it, that's probably not right? Because things happen, life happens. Even in our own lifetime, we've seen the dot-com bubble, we've seen the global financial crisis, we've seen coronavirus, we've seen Donald Trump being elected. These were things that no one expected, but sadly, in some cases, they happened. So just always be quite skeptical, but also quite pragmatic about it. I think sometimes people they're very emotional when it comes to investment, and the objective with investment really should be trying to take emotions out of it entirely. Just be very scientific. Like, look, I have 100,000 pot. This is a great investment. I think it's a great investment, but at the same time, I can't see the future. I don't know what's going to happen. Let's put 5,000, 10,000 into it. What we often see when I talk to people is they get really excited about an investment and they want to put in 50,000 into it, and then they come to regret it afterwards. Don't do that. Just keep diversifying, because then you're going to have a little bit of exposure to that. And if that does excellently, right, let's say you put it into Bitcoin, a little bit of money into Bitcoin, 5, 10 years ago, and that did really well, you won't be sad because at least you're getting some upside, but you won't be really disappointed if you had put a load of money into it and then Bitcoin crashed and you've got all that sort of thing to deal with. So in a nutshell, diversify. So then what I'll do here is I'll just really quickly whiz through, and this is really a whiz through. There's a lot more to be said about each of these steps, and I imagine you can't see it, but I'll talk you through it. And inshallah, you can find out a lot more on the website or a lot more on the internet if you're interested as well. So at birth, let's say you have a kid. What are the two key things that you should be aware of? The first is the junior ISA. So this is a savings account that is tax-free. And actually, in the budget that was announced this week, they actually increased the limit to £10,000. So what's that? Sorry. Yes, 9,500 or 800, so I'm just rounding it up to 10,000. So that is the limit now, and the key thing there is that what happens if you put in 10,000 and that 10,000 becomes 50,000? What would normally happen is on the 40,000 profit, you would have to pay tax. But if you are in a junior ISA, you don't have to pay a penny of tax, which is really, really valuable, right? And you can do that for each of your kids, create junior ISAs and put away pockets of money for them. And actually, I was doing some numbers that if you were to, let me tell you about the child SIP and I'll give you the numbers on that. So the child SIP is a self-invested pension plan. So children, you could actually start giving them a pension plan from when they're born. And bear with me when you think this is actually crazy. Why would you start creating a pension plan for your child? The reason is because the longer your money is in the market, the longer your money is in that pot, the more it mounts up over time. And so if you started your child off with a pension plan, which by the way, the government gives you a 20% bonus on because they really want to encourage pensions. So if you put in £2,880 every year, which is the maximum, they would top it up to make it 3,600. So they would actually give you and your child, well, it would be your child actually, free money as a result of that. Now the catch is, of course, that you can't liquidate it. You can't take it out until the child is actually, 60, 65. That's when he'll get hold of it. But the point of it is, the value of it is that even if you just put in 50 quid a month from when your child is born to when he's 60, 65, that adds up to something like £350,000, which is a decent amount of increase on their pension. And the same with junior ISAs. That stuff really adds up as well. So if you just keep on going with, even £100 or 50, £100 over 18 years, when your child gets to, going to university, that adds up to something like 80 to 100,000, depending on obviously how the markets do and how much you put in. And that's quite a nice, sum of money, especially for then paying off the student and university fees.
The two things which you just mentioned, are they not all linked to interest?
Good question. So what is a junior ISA? What is a SIP? It's really just a label for an account that you can set up with any broker. So, you've got stockbrokers like Hargreaves Lansdown, AJ Bell, IG. You'll see their, adverts on the tube and stuff. Those are the people that I'm talking about. You can go and just create a junior ISA, just go on their website and click junior ISA, or go on our website and we have articles on junior ISAs which link you directly to where you need to go. Just go on there, create an account, and you can then choose just Islamic investments. And you might be thinking, okay, well, I don't know what Islamic investments there are. Well, we've helped you out on that front as well, because a lot of people had this question. Where's it gone? So yeah, there's a list of various different funds that you can Google. So the Oasis Crescent Global Income Fund is halal. The Salam Sachs Sukuk Fund is halal. You can look at iShares Emerging Markets Islamic ETF. I mean, all of these, and there's lots more information about it that you can find on the website as well, like how much fees they charge, what kind of return they've had annually, and all that sort of thing. But the point I'm making is that it's all you need to do is create an account and just basically put it into 2 or 3 of these. Not even worry too much, quite frankly. I think about what you go for. Just look for something that seems reasonable enough, doing well, and put it in there and just let the markets do their work, because over time, markets trend upwards as we'll go into. So that's birth.
Sorry, but how do we know that these particular things are really halal investments?
So each of these funds, they have, I mean, this is ultimately, this is a decision for you, right? If you think it's halal or not. But all of these funds have Shari'i boards who have qualified scholars on there, and they have Sharia certification, and that's what makes them Sharia compliant. And then, we cover them, but you can go on Google it and research it yourself and find out exactly what's what. All we've done is just compiled all the Sharia funds that we know, and we talked to AJ Bell and others to actually compile that entire list from their universe of thousands of funds. We've worked out with them what are the halal ones, so that it's just easy for people. So yeah, that's junior ISAs and child SIPs. University, so really quickly, you should try and avoid student loans. My view is that student loans are loans. They're not permissible unless it's really, really necessary for you to get loans, in which case, you can probably talk to a scholar, but ultimately, potentially go for it. But even then, it shouldn't be an easy thing. Even then, I think you should be working whilst at university to try and avoid it as much as possible. Really try and look for a bursary or scholarships, because there's a huge amount of these and people don't know about them. There's actually a company called jamma.co, JAMMA.co, which is going to very shortly launch a list of just all the bursaries and scholarships that are available for BME students, black and minority ethnic students in the UK, and there's a lot of them. So just make a note of that, jamma.co, and you can look that up, inshallah, when they launch that. And we'll be covering it definitely when they launch. We'll be covering it on our website as well. So, university, obviously expensive time, but key thing is save up beforehand, but also, try and avoid student loans as much as you can. And even if you have to get one, try and minimize and, try and work to, avoiding having to, pay student loans. So the next thing is you get your first job. Absolutely essential thing that you should be doing here is getting enrolled onto your pension. It's really critical that you do this. And lots of Muslims unfortunately don't do this because we're not really sure if it's halal or not. And actually, a lot of pension providers have halal options available within their universe. If they don't, and there are definitely pension providers who are like this, get in touch with me. And so I'm a lawyer, as I said in my background. I've done lots of discrimination cases. I am literally looking for a test case because I think it is discrimination if they don't have a halal option available. So I'll be willing to fight that case for you guys and try and get that sorted. But usually speaking, most people they do have it, or if they don't have it and you kick off, they'll get a halal options in there. And the reason why all of this is so incredibly vital is because legally employers have to contribute 3% of your salary to your pension. That is, in other words, that is free money that your employer is giving you on top of your salary, that if you don't enroll onto your pension, you will be essentially just saying, bye-bye free money, I don't want it. And that free money, obviously, over 20, 30, 40 years adds up to a huge amount of money. I only worked in my first workplace for about 2 years, and at the end of it, my pension was like £5,000, and it just suddenly mounted up. And if I hadn't enrolled, of course, I wouldn't have that £5,000. So really, really important that you do that.
Can I ask a question?
Yeah.
What's the minimum you have to put into the pension?
Good question. So I think now employers are moving towards automatic enrollment, so they actually get you involved straight away. I don't know off the top of my head what the minimum is, but I.
2 years old.
What's that?
Once you're 22, you get auto-enrolled.
Yeah, but even you can do it before then as well. So you can have a pension before.
Manually do that.
Yeah, I see. Interesting. So you don't actually have to enroll on your pension. You can opt out and just put in 0. But typically, people say that you should be investing between 1% and 5%, depending on how much your salary is. Like if you're making a massive salary, you can probably put in 5% and not feel it. But if you're making, you're younger in your career and you may not want to put in that much into your pension, then maybe a little bit less. But do bear in mind that the more that you put in earlier, the better it is. Like, so I was doing some numbers. If you invested from like the age of about 20, your pension would be worth, let's say you invested just £100 a month, your pension would add up to something like 370,000 by the time you retired, around 60, 65. But if you had started your pension at the age of like say 40 and invested for 25 years, it would just be £90,000. So it's not proportionate, do you see? Like it's not like if you invest earlier, even if it's a small amount, that adds up and it snowballs a lot earlier. So the key thing I'm saying is, first job, get yourself into the pension. And if it doesn't have a halal pension, talk to me. Marriage. So Islamic wills. You should have an Islamic will, especially once you're married. You should be legally married to your spouse because you get a whole load of tax benefits as a result of that. So if you're legally married to your spouse can inherit from you tax-free. And if they're not legally married, then they can't do that. There is a tax-free allowance, but it's much, much better if your spouse is married to you legally, because then everything that you give to her will be tax-free. And then when she dies, there will actually be a double tax-free allowance. So if she dies, with all of your assets, and then she dies, she'll have up to, it adds up, but roughly £650,000 is the tax-free allowance that she'll get. And it actually now adds up to, including a whole bunch of other things, it can be up to £1 million is tax-free. And we've got a guide on Islamic wills where you can get it. We do one, but we're not bothered at all if you use us or not. There's free wills that you can use if you're a student or you don't have much, in terms of assets. It's probably better for you to go for a free one. If you are a high net worth individual, so you've got a business and assets over £1 million, then you should probably get a bespoke will done by a solicitor. and that's a trust-based will because that's better for your tax planning. For everyone else, so you've got some assets, you're not a student anymore, but you're not a millionaire. Then something like the IFG will is good, but again feel free to go elsewhere as well. Then you've got the marriage allowance. Marriage allowance is a nice little perk. So if your wife doesn't work or your husband doesn't work, God forbid, then you can actually transfer over the person who, let's say your wife isn't working, she can transfer over a bit of her tax-free allowance to you. So net, you'll end up with an extra £220. And if that's in your situation, talk to an accountant or just Google it online. This is important for your self-assessment. When you make it every January, that's when it becomes important. So have a think about that. And again, just to reiterate, I know there's a lot of information here. What I want to do is give you a whistle-stop tour so you have at least an idea of what's going on. I appreciate that I'm not going into exhaustive detail on each of these things, but you can go, if you subscribe to our website, the very first thing we do is we literally send you through a crash course on personal finance, because I know that there's a lot of stuff to take in, and we've got a whole load of free resources for you guys to look at. So you can look at that as well to kind of back up this hour of knowledge that I'm throwing at you, which might not be all. You might not necessarily absorb all of it in one go. So first house. So key tip there is try and get yourself up to a 20% deposit rather than a 10% or a 5% deposit, because the difference is massive. So with a 5% deposit or a 10% deposit on a mortgage, you'll be paying something like, and this is using Islamic mortgages, you'll be paying something like 4.5%. So we actually have an Islamic mortgage comparison as well, if my computer lets me show you it. So yeah, so here we have a situation where you've got £160,000 that you require for a £200,000 house. So that's a 20% deposit. So that's 3.19%. But if you put that to 180,000, that suddenly becomes 4.5%, which is a big jump. And you'll feel that in your day-to-day spending and day-to-day monthly finances. You'll feel that it'll be a difference of, like, let's say $1,200 a month versus $1,800 a month. So it's a big jump. So it makes a lot of sense to go for a 20% deposit. Just save up a little bit more, even if it takes a year more, get to that 20% mark, because you're going to get much better rates as a result of that. And also, frankly, it'll be a little bit more comfortable as well, because there's a whole load of additional costs when it comes to buying a house. Lawyers and surveying and all this kind of insurance and all the rest of it. So just having a bit more of a buffer is better. But if you're in a hurry and you really need to go for it, then obviously go for it. And we'll talk about that in detail next week as well, inshallah. So then finally, you've now got through your first house, you've got a bit more spare cash, you can be a bit more aggressive with it, you can be a bit more diversified with it, and then finally when you die, obviously you've already got your Islamic will sorted, so as a result of that, you'll end up saving, on average it is said, about £9,700 to £10,000, because people lose assets. So with wills, the benefit is all your assets are listed in one place, and people know what's going on. Whereas if you don't, then I'm thinking about my dad or your parents. They'll have some property in Pakistan, or they'll have some property in Bangladesh or something, and there's some kind of like qabza, dispute going on, and you don't really know what's out there, and it could be that property is worth a lot of money, but because you have no idea about it, then the guy who's done the qabza will be really happy, because no one's going to dispute after your father's passed away, and that's his. So in other words, that's how on average people end up losing money if they don't have wills, and also then they have to go through the court process. But really, actually really importantly for Muslims in particular, if you don't have a will, then legally your estate, your money, will be divided up in a way that's contrary to the Sharia. So the Sharia has a very specific way how your estate should be divided. But if you don't have that, then the laws of intestacy apply. The UK laws apply, and they're distributed in a very different way. And so your will, your final, your final testimony is really important to make sure it's Islamic. Yeah.
How do you keep it up to date as your assets change?
Good question. So, I mean, when we do it for people, we say that, you can, the way we design it, the way we write it, it basically doesn't matter if you're, some of your inheritors unfortunately pass away, or you might have some new assets coming in. The will itself is legally binding, but you are right, it's better to update it every 5 or 10 years, because at that point you might want to make different kind of bequests, and at that point you might want to just refresh that asset list as well. It is still legally binding even if you don't do that, but it's better to kind of refresh it. And so we have like a, if you've gone for a will with us, we'll do it at a discount if you come in after 5-10 years and say, can I update it? Or you can just update it as you go, whenever you want, as many times as you want, for like a subscription of, I think it's £10. So that's the personal finance timeline in a nutshell. Then we're going to launch into the 3 essentials of halal investing. Isha's at 7:30 still, right?
45.
Ah, excellent. So I can relax a bit. So 3 essentials of halal investing. The first is that, so how can you become like Buffett, the well-known Muslim billionaire? Warren Buffett, right? Sorry, I couldn't help myself. So the first thing is you should actually invest. So not have money just sat on the sidelines. And maybe this is an opportune point to just give some very, very brief thoughts about coronavirus and how you deal with your money in like turbulent market situations like this. I think in a nutshell, the point is that you are, and I am, an amateur when it comes to stock trading. We're not stock traders, and to do that well, you need to have some experience, you need to have some time, and you need to have an aptitude for it. We're not stock traders. We are investors. We're passive investors. We're looking for returns over a long period of time. And with things like the coronavirus, of course, markets are really choppy. And unless you're very high risk and you enjoy this stuff, I wouldn't try and play the markets at this point. I wouldn't try and go in and see, X stock has dropped a lot and I reckon it's going to bounce back up. Let me just buy it and then sell it again tomorrow. Because when you're doing that and you've not got the experience to do that, even if you do well for a few trades, ultimately I think that is a foolhardy endeavor, because you're not a professional and you're not even planning to become one. You're just being opportunistic. It's like when you're a tradesman. Let's say you're an electrician. So fun fact, in my gap year I actually trained to be an electrician. So let's say you're an electrician and you see people who come in, cowboys, or you see people come in and they just do like a particular job and they think they can do well. And they might have done a job well at a certain point, but sooner or later they'll get found out. And they'll get electrocuted, or someone will get electrocuted, and there'll be some kind of claim or something, and things go wrong. It's the same with the stock market. It's a dangerous tool. I don't think people should play with it unless they're comfortable. So what should be done then? People do have pensions. My view is that pensions and things like that are long-term assets, and you shouldn't really worry too much about it, because firstly, you can't liquidate your pension. Secondly, even if you could, if you just leave stuff in cash, you're losing money anyway because of inflation. So long run, I wouldn't worry too much. If you're going to invest right now, I'd keep it very diversified. I'd try and keep it in things that you understand, and in things that are well recognized to be good options for investment. So things like property, or sukuk funds would be quite a good option. Sukuk funds are like these kind of fixed income, quite passive, relatively low volatility relatively safe assets. Savings accounts could be a good option. I wouldn't actually be against putting money into the stock market either, going for established companies like Shell or other companies that have, as a result of the overall market decline, come down and are quite cheap now. But I wouldn't try and trade them. I just buy really a few funds or a few big companies and then just hold them for a long period of time, because that's really, honestly, that's the important thing. Good investment is boring. Good investment, you just leave it and then you don't touch it for ages and ages and ages, and that's where you make your money. So invest like the 1%. So we'll talk about how the 1% invest. They do three things. The first is they're consistent and regular. The second thing is they diversify. And the third thing is they have long-term time horizons. So let me make the point about consistent and regular. This is the net worth of Warren Buffett. Something like 60 billion. I think is actually more now. And he started investing at the age of 14 with £5,000. And if you see, it's actually right at the end that his assets have really mushroomed and really ballooned. And that is because he was consistent and he was regular throughout his life in sticking some money in, investing his money, and the magic of compounding and the magic of being consistent then really took hold and it escalated quickly. So that's the first thing. Consistent and regular. The second is diversified. So I think I showed this similar slide last week. So if we look on the left is how we normally invest. So we normally invest in stocks, cash, and bonds. And we have a lot of cash on our hands. The 1%, on the other hand, you can see it's a lot more mixed. So they're investing in real estate, private equity, stocks, cash, bonds, hedge funds, and then other. There's a whole bunch of other things that they're investing in as well. So diversify is a key lesson there. And then the third thing is, and again you might be thinking, hang on, diversify, but I don't know where to find this stuff. Well, again, that's part of why we've created this comparison tool, because we found a lot of people didn't know where to find stuff. So we've kind of put it all in one place for you. And then the final thing is long-term time horizons. The reason why I keep on banging on about this is because if you look at these graphs, that's the stock market graph over many, many decades, since the 1960s. And where is it trending? Is it trending upwards or downwards? It's trending upwards. And then on the right, you see the FTSE 100 graph since the 1980s. And you see that overall there's a period where it's labeled party time. So the markets, when they move, the markets are not rational. The markets overreact and in times of plenty and also in times of hardship. So they overcorrect. When things are going wrong with things like coronavirus, they'll sell everything and things will become cheaper than they should be. And in times of plenty, when things are going well, they'll become really excited and buy a lot more than they should do. So things will become more expensive, or the stock market will rise more than actually it should do. And so as you see here, there's like a rational path. It says rarely traveled. So that's like that blue line that just kind of, the linear line is like that. But the markets don't go like that. The markets go up and down, up and down. In a nutshell, what I'm saying is, over the long run, markets do follow that linear path. But if you are trying to invest short term, you're putting yourself at risk to these kind of choppy movements in the short run. So 5 investment categories. Really quickly then, stocks. So any ideas what is a stock? It's not really a trick question. Yeah, go for it. Oh, sorry. What's that? Equity. So what are you buying when you buy a stock?
A share in a company.
Exactly. So you're buying a share in a company, you're buying a stake in a company, and as a result of that, you will sometimes get dividends. So that's like a return, annual return or a quarterly return from that. But you're also hoping that the company becomes more valuable and it goes up in value. And so stocks are great, and you should invest in stocks because they're one of the most available assets in the world. if you think about the employers that you know, you might be an employer yourself, you might be an employee working for an employer, right? What is it that makes the world, the economy go around? It's businesses, right? Either you are a business or you work for a business. It's businesses that make money, that add value to the world, and that's where they're profitable. And so overall in the economy, you want to be putting your money in with people who are actually making money. So as a result of that, you'll get some profits out of it. And that's what stocks are. Stocks are shares in companies. And there's various different ways that you can invest in stocks. So I've listed 5 here. The first is there's various different flavors of this as well. So the first is if you are quite well off, let's say you've got over £100,000 to invest in stocks, then you should go for a financial advisor. You can probably afford to pay a bit of money and get that financial advice. We're not financial advisors, by the way, but you can find financial advisors, and I think we have actually some reviews of financial advisors as well on the website, and talk to them and see what they're saying about where you should put your money, and then you can crack on and do that. The second approach is you can go for a robo-advisory approach. So this is for people like you and I who may not necessarily have a large amount of money to invest, and in those situations you don't probably want to pay like £500 or whatever it is that you have to pay to get financial advice. In those situations you can go for people like Wahid Invest, you've got people like Sarwa, Simply Ethical now do one as well, and there's a whole range of these companies that are cropping up. What these guys do is, rather than doing financial advice with you in person live, they kind of get you to just online tick through some questionnaires and give you guidance online, and that's obviously a lot cheaper for them, and that means that they can provide you a service for free, and the benefit for them is that then they hope that you will then invest with them onto their platform, and you can invest with people like Wahid and Sarwa and all these other ones for like £100 a month or however much you want to do, and that's another way of investing into the stock market. And the benefit again here is that these providers, they have ready-made portfolios, so you then don't have to think about, oh, actually I don't know what to put my money into now. They take care of all that for you. And I actually used to have some accounts with these guys as well until very recently, when I had to sell to buy a house. But they're great, in terms of just low headache and low mind space. It's great. Then before that, a few years ago, when I had a bit more time, when I didn't have a son, I did some stock trading and investing myself. And that was DIY. So this is option 3, DIY investing. And so this is if you are really interested in the stock market. I wouldn't do it, because you think that's a way of trying to, get around the fees and that sort of thing. Because ultimately you'll probably end up paying, a lot because of A, your inexperience, and B, you'll be paying fees anyway to brokers, because every time you buy and sell a stock, you're going to have to pay brokerage fees. So DIY is where you go onto something like AJ Bell or IAG or something, which is a stockbroker. And these stockbrokers, they have a direct link with the stock market. So you can't go to a company like GlaxoSmithKline or a company like Boots and say, I want to buy shares from you in the shop, right? That doesn't happen. You have to have a broker who's connected to the London Stock Exchange, and all the other brokers are connected to them as well. And then you set up an account with them, and they then trade on your behalf. So that's how you do DIY investing. And you can create things like ISAs there as well. And an ISA is basically a tax-free wrapper. It's basically just a tag that you put on whatever account you set up with these guys. Robo-advisors have it, financial advisors will help you with it, and DIY, you can definitely do it as well. The benefit of an ISA is that $20,000 a year is tax-free. You can put into an ISA £20,000, and that is tax-free. So if that 20,000 becomes 100,000, you don't have to pay a penny on the profits that arise out of the 20,000. And then finally, you've got option 4. So a lot of you will have pensions, so you actually already have a lot of exposure to the stock market already. So that's the 4 ways that you'll get some access to stocks. The second option is sukuk. So if you notice, the key thing that changed here is basically just one thing, and that's option 4. So firstly, what is a sukuk? Any ideas what is a sukuk? A bond. What is a bond for people who might not know?
You want me to explain it?
Yeah, go for it.
It's a loan, and you get it's not interest, but you get an return.
Yeah, so exactly. So a bond is actually basically a loan. So the government issues bonds. They say, give us £100,000 and we'll slowly pay you that back, and we'll give you an interest amount on top of it. And the government does a lot of this, and actually with the new budget that's been announced, they're going to do a lot more of it. And that's what a bond is. A sukuk is economically exactly the same, in that you are going to give up front, you're going to give a bunch of money, and then over time you're going to get that back with a bit of return on it. And the way that a sukuk works is that they have structured these sukuk so that it's linked to some kind of property. So instead of an interest rate return, you're getting some kind of rental rate from some kind of property that might be structured depending on wherever the sukuk is. It could be in this country, it could be elsewhere. They'll be giving you a fixed return for that. So for example, Ar-Rayyan have issued a sukuk, and Ar-Rayyan will pay a bit of the rent that they get from all their various different mortgages, and they'll pay you that back as your rental return. So where can you buy sukuk? So sukuk, you can buy it via financial advisors. You can get it via robo-advisory companies again. You can try and get it DIY as well. So if you create an account with stockbrokers, then they also have within that window, they have a whole range of other products as well, including sukuk. And if you're struggling, just come onto the website. We've got a list of all of the halal ones that you can go for. And then finally, if you've got a bit of spare cash, then there are some bespoke sukuk. So things that are a bit more high risk, high reward. We run an angel syndicate that I set up about I think a year and a half ago now, and this is basically because I was doing stuff, I was investing in things, and I realized that you get better rates and you get better access to good deals if you club together with other people. So it's essentially just a club of people who have a bit of spare cash to invest, and through that we've been getting some interesting high risk, high reward sukuk, which are not ideal for everyone, but they're ideal for people who have a bit of spare cash that they're willing to put into something a little riskier. So those are the options to get sukuk. Do I see a hand there?
Yeah. What's the typical return on the sukuk, which is the government bond?
Yeah, so it really varies because sukuk in particular, with bonds, a lot of governments issue them, so they're really safe. And they offer really really steady returns. It's not massive returns. It's a few percentage points. It's not great. But then you get more riskier sukuks, more riskier bonds like corporate bonds. So companies offer them, and obviously the better the company, the lower the return you'll get because it's lower risk. But if you've got a company that is a bit more high risk, a bit smaller, then you'll start getting better returns on it. But typically you'll see sukuk ranging anywhere between like 1% to up to 15% sometimes of the more high risk stuff. But yeah, it's a real spectrum. Right, so we've got property, and I'm thinking, let me just. Yeah, so I'm probably going to talk another 10-15 minutes, and then I think there's probably quite a few questions. So inshallah we'll discuss it around the questions instead. So in terms of property, this is every Muslim's favorite investment that has been drilled into us from when we were very young, and I'm no different. Mashallah, there's a lot to be said for property. it is literally safe as houses. So, great asset to be involved in, but it shouldn't be the sole asset that you should be involved in. And there's a whole range of ways that you can get exposure to property, because property is not just one thing, it's a whole range of different things. The first thing is you can get access to, the very first thing you can do is DIY, which is actually the fifth option here. You can buy your own property and you can, rent it out, or you can buy your own property on auction. If you've got cash, do it up and sell it. Great, right? That's a way of getting exposure to property. But if you don't have that money, you can actually still get exposure to property through companies like Yielders. There's another company called Igloo Crowd. There's another one called Brick Lane. There's a few companies now where what they do is they say, why don't you invest just £100 or 200 or however much you want to do with us, and then we'll club it all together, and then we'll all buy this property that we can then all rent out over a 5-year period, and you will keep on paying you fixed returns every month on the rent comes into us, we'll pay out to you, and then at the end of it we'll sell the property and then we'll pay out the profits to you. And that's been a fairly successful model, and I've used it myself. I've not exited yet, but I'm getting the rental returns in, so happy days so far. And all of these companies, by the way, they're all FCA regulated. So all the stock companies that I mentioned, all the property companies that I mentioned, they're all FCA regulated, so that's obviously helpful. Then you've got property crowdfunding where they do developments. So developments are typically more returns. So with property crowdfunding rental returns, you're looking at somewhere between 5 to 7% a year. But with developments, it's much shorter, 1 to 2 years, but you're going to end up with something like 10 to 15, 16, 17% returns. But they, generally speaking, they want a bigger investment up front from you guys as well. So that's another option. Investment. So Yielders, they for their developments, they ask for a 50,000 initial investment, and but if you kind of talk to them and say, look, I'll invest a little bit later on as well, they can do 25,000 as well. But on the website they say 50,000. Then you've got land crowdfunding as well. So this is going a step earlier. This is getting like a greenfield site, just like a field somewhere, and buying it on the hope that you'll get planning permission and you'll be able to add value to it, build a plan, and then then develop something, or even just sell it at that point as well. So this is a different kind essentially of investment, because it requires a different kind of skill set. It requires planning and surveying kind of skill sets, and being able to pick the right land opportunity. And so there's a company called Intro Crowd who do that, and the minimum investment there is £5,000. They do that, and that's an option to go for as well.
Is that Islamic?
Yeah, so that they work with Mufti Faraz, Intro Crowd. Then you've got REITs. So these are real estate investment trusts, and real estate investment trust is basically what it says on the tin. So it's just normally listed trusts that you can buy into, and they hold a whole range of properties, lots of commercial properties, lots of rental properties, and their whole objective is to hold properties that are going to give you a rental return, and then they pay you that rental return back. Not all of them are necessarily Sharia compliant, and it is very much on my to-do list. I was thinking about this when I was preparing it, to create a list of REITs that are halal to invest in. And actually, funnily enough, things like, Yellow Box, I think, is a storage company. There's a few storage companies. They are actually REITs. Really, their business is that they're real estate investment companies. And the storage bit of it is a thing that we interact with, but at heart, they are real estate investment companies. And I think they're Sharia compliant, but I'll need to check that. And then finally, obviously, get an Islamic mortgage, get your own property, because as I was saying, that's a great way of getting exposure to property, saving on your rent as well. Savings accounts. So you can have savings accounts with people like Arayan, Gatehouse, BLME. There's a whole range of them now, and they actually offer best in market rates, even better than non-Muslim banks. And the reason for that is because non-Muslim banks, they don't need savings accounts to fund all their mortgages that they're issuing out. Because for the mortgages, they'll just borrow off the Bank of England really cheaply. But Ar-Rayyan and Gatehouse can't do that because that's obviously haram money. So they have to go to their savings accounts, which they've got Sharia compliant savings accounts, and they offer returns that are much higher than the market. So it entices lots of money to be pooled into their savings accounts, which they can then use to give out their various different mortgages. So that's why they give the best returns. But even then, it's not great returns. It's like 1.5% to 2% max. And given inflation is somewhere between 1.5% to 2%, it's basically you're just running on the same spot. So it's a kind of place that you'd put money if you need it. It's liquid money, but it's not going to make you a wealthy person necessarily.
Can I just quickly ask?
Yep.
Yeah, so no question. So
That's all right. There'll be plenty more options. Then finally, private companies. So private companies are companies that are not listed on the stock exchange. So most companies will be private companies. And there are basically two ways that you can invest in private companies. One is equity. The other one is debt. So what does that mean? Equity means that you're taking a stake in that company or buying shares in that company, just like the stock market, but they're not listed is the difference. And that's a big difference. The big difference is that if you buy shares in BP, then in a month's time you decide that actually I need a fridge and I don't have money, you can sell the shares in BP and buy yourself a fridge. But if you have bought into a private company, let's say it's an exciting startup business that you really like, you've invested 5,000 into that, you're not going to be able to get that back after a month's time or even 2 years' time, 5 years' time, 10 years' time sometimes. But there is a real upside there because the reason why people still do that is because of a whole bunch of reasons. I mean, the first big reason is tax breaks. So if you invest in startups, then you get up to between 30 and 50% tax breaks in year one. So, last year, I invested a bunch of money into startups, and let's say I invested 10,000 into startups. As a result of that, I got back £5,000 in my tax in year one. So that's just cut my risk down by half, which is great. And this is a reason why a lot of people invest in startups. A lot of non-Muslims, frankly, invest in startups. And it's a reason why the government have this scheme in place in the first place, is because they want people to invest in startups. Why? Because that's where a lot of the innovation happens. That's why Silicon Valley in the USA has done really well, because people have invested in startups, they've created massive companies, and the UK government wants to encourage that as well so that the UK economy grows. So startup investing is one way that you can invest in private companies. As I mentioned, we have a syndicate, and one of the things that I actually started off with was investing in startups. So that's one way that you can get access to startups. ifg.vc is the specific address to the syndicate, if that's to your liking. Then you can go on crowdfunding websites like Seedrs or Crowdcube and others. And these guys, so with our syndicate, because it's basically just a club of family and friends, we have a minimum investment of 5,000, but with Crowdcube and Seedrs, it's a minimum investment of I think like £100. So it's a lot more accessible. But the slight downside is that anyone can list on Seedrs and Crowdcube, so you don't necessarily have that filter. You don't know if it's a good company or not. Generally, they're all right companies, but it's kind of on your judgment then, as opposed to relying on the judgment of the syndicate. And there's not just us. There's lots of other syndicates, but relying on the judgment of syndicates and what they're thinking.